Welcome to the Deep Dive. This is where we take your source material articles, research your notes, and really extract the most important nuggets of knowledge or insight, basically giving you a shortcut to being well-informed. Today we're doing something, well, truly special and custom-tailored just for you. We're going to tackle some of the trickiest questions and concepts you stumbled upon while studying for your California real estate exams. Think of this as your personalized audio study guide, yeah? Designed to clear up those specific areas where things got a bit fuzzy.
That's exactly right. It's incredibly valuable to identify those exact points of confusion, the ones that made you maybe pause and scratch your head. Sometimes the most frustrating moments in studying are when you think you understand a concept, but then, a subtle nuance on a practice test just throws you off completely. So by zeroing in on those particular areas, we can really solidify your understanding, and not just for the sake of passing an exam, but for truly comprehending the intricate world of California real estate law, finance, and practice. We'll be pulling directly from your California Legal Aspects of Real Estate Study Guide and dissecting some common practice test scenarios to really nail down those challenging concepts.
Yeah, our mission today, to take those frustrating wrong answers you might have encountered and truly transform them into genuine aha moments. That feeling where everything just clicks into place. You've absolutely got this, and we're here to help you get there.
Navigating the legal landscape, California license law, and DRE powers.
So, okay, let's dive right into what really underpins the entire real estate industry in California. California Department of Real Estate, or DRE, it's definitely more than just a licensing body, isn't it? It's truly the watchful eye of the industry.
Oh, absolutely. The DRE isn't just some bureaucracy with a rule book. Think of them as having two massive, overarching jobs, really, like two core missions that drive everything they do. First, and maybe most importantly, they exist to regulate and monitor the entire real estate industry, and that's both residential and commercial, specifically to protect the public's interest in all real estate transactions.
Yeah.
Ensuring fairness, transparency, ethical
And
conduct.
protecting the public, that's key.
Exactly. And second, they efficiently provide services related to licensing, subdivisions, and consumer needs. So this dual mandate of regulation and service means the DRE acts as both a gatekeeper and, well, a facilitator. The deeper insight here, I think, is that they're not just policing, they're actively shaping the integrity and efficiency of the entire California real estate ecosystem. It's really about building and maintaining public trust, which is, the bedrock of a healthy market. Makes them way more influential than just a simple licensing office.
That makes sense. So how do they enforce that? What kind of powers do they actually have?
Well, to accomplish these goals, the DRE has pretty extensive powers. They can approve education providers, making sure new licensees are properly trained before they even step foot in the market. They administer licenses, of course, from initial applications all the way through renewals. They investigate complaints from the public or even other licensees, which can then lead to formal disciplinary action.
Okay, so they handle complaints too.
Yeah, and they also administer the consumer recovery account, which acts as a kind of safety net for consumers, like a last resort for those who've been financially harmed by a licensee. They enforce subdivision laws, making sure developers disclose all the necessary info to protect buyers of new homes. They manage funds for education and research to further improve the industry's professional standards. And finally, they monitor mortgage broker activity, extending their oversight into the financing side of things to protect consumers from, say, predatory lending.
Wow, okay. It sounds like the DRE really is the ultimate authority when it comes to maintaining standards. So for our listeners who might have encountered a practice question about license denial, it seems they have some serious power when it comes to who gets a license and who doesn't. One area that can be a bit tricky, I think, is understanding the consequences of past actions on licensing eligibility, especially concerning these crimes of moral turpitude. What does that actually mean?
Right, indeed. The DRE absolutely has the power to refuse an applicant a license or even restrict, suspend, or revoke existing one. And this is particularly relevant when it comes to past misconduct, specifically these crimes of moral turpitude. Now, a crime of moral turpitude, that's a legal term, basically for actions that fundamentally betray trust or integrity. I mean, think about it. If you're dealing with people's biggest investments, their homes, you absolutely have to be utterly trustworthy, right?
Totally. Trust is everything.
Exactly. That's why something like perjury, which is, lying under oath, would immediately disqualify someone. If an applicant has been convicted of perjury, which is clearly a crime involving dishonesty, the DRE will absolutely refuse that real estate license application, period. It's not any old crime that causes denial, but those specific ones that go right to the core of an applicant's integrity and trustworthiness. Those qualities are just non-negotiable and fundamental to real estate practice. Other examples that would probably fall under this umbrella could include things like grand theft, embezzlement, or serious fraud, really. Anything that demonstrates a profound disregard for honesty or the law in a way that suggests a person just can't be trusted with public funds or property.
Okay, that clarifies the moral turpitude part. So let's say you successfully navigate that whole application process and you get your license. How do you keep it in good standing? What are the basic requirements for renewal? And just as important, what activities always require a license versus those that don't? That seems like another common exam area.
Good question. Once you're licensed, a California real estate licensee has to renew their license every 4 years. It's a fixed cycle, helps ensure regular compliance. For salespersons, both their initial first renewal and then all subsequent renewals require 45 hours of DRE-approved continuing education coursework. This makes sure licensees stay current with, evolving laws, ethical standards, best practices in this dynamic market.
45 hours every 4 years.
Okay. Now, regarding who needs a license, this is a really broad net, and it's designed to protect the public from untrained or unscrupulous individuals. Generally speaking, anyone performing real estate services for compensation needs a license. This includes things like selling, offering to sell, purchasing, offering to purchase, listing properties for sale, negotiating exchanges, leasing or collecting rent for others. Crucially, it also includes seeking, negotiating, or collecting on loans secured by liens on real property. So basically mortgage broker activity. If you're getting paid for these activities for someone else, you almost certainly need a license.
Almost certainly.
Yeah.
But there are exceptions, right?
Yes, and these exemptions are crucial and often pop up on exams. You don't need a license if you're primarily selling or leasing your own property. Now, there's a caveat. Unless you're engaged in a pattern of activity that suggests you're operating as a dealer, like maybe dealing with 8 or more sales contracts annually. You also don't need one if you're acting solely under a power of attorney specifically granted for the sale or lease of a particular property, because your authority comes from that legal document, not brokerage activity. Similarly, if you're performing duties as an attorney, say, handling a real estate transaction as part of your legal representation for a client, you typically don't need a separate real estate license. Your authority stems from your legal practice. Same goes for someone acting as a court-appointed receiver or a trustee, like an executor selling property as part of an estate settlement. Their authority comes directly from the court. But yeah, if you're any third party being compensated for bringing buyers and sellers together, facilitating an exchange, or even just collecting rent for someone else on an ongoing basis, that's where the DRE steps in and says, hold on, you need a license to do that legally and ethically.
Okay, that scope is much clearer now. And while the DRE certainly has broad powers over licensing and discipline, a huge part of public protection really comes down to something super specific: how licensees handle client money. This next area, the critical difference between commingling and conversion, is a classic test-taker trap. They sound so similar, but the DRE treats them very, very differently, right?
Oh, absolutely. And the DRE takes both with almost zero tolerance. The real insight for exam purposes, and frankly in practice, is that the DRE views commingling as compromising the integrity of trust funds, basically opening the door to potential conversion later. So commingling is simply the illegal act of mixing personal funds with a client's funds. The key here is the mixing itself, regardless of your intent. Even if the money isn't spent, the act of intermingling personal and client funds in the same account is prohibited. Imagine a broker, maybe unintentionally, just deposits their personal paycheck into the same trust account where they've put a client's earnest money deposit, maybe just to cover an unexpected personal bill real quick. That's commingling. It's almost like a no-touch rule for client funds. If you even think about letting your personal funds shake hands with client funds, alarm bell should definitely be ringing. It's that serious.
It's the mixing is the problem.
Exactly. Then conversion, on the other hand, occurs when those commingled funds are actually spent on something unintended or personal. Using the same example, if that broker then uses those mixed client funds to pay their brokerage's electricity bill or cover their personal rent, or even buy a new office chair, that's conversion. It's the appropriation of funds for unauthorized use. So commingling is the mixing, conversion is the spending of the mixed funds inappropriately. The DRE's strict stance on commingling is really a preventative measure, protecting the client's money from any risk, even accidental misuse. And that subtle distinction is where people often get tripped up.
Mixing versus spending. Got it. But isn't there that small exception? The $200 thing.
Yes, good catch. There's a very specific, narrow exception to commingling that often confuses people, but it's a crucial detail. A responsible broker is permitted to deposit up to $200 of their personal funds into a trust account. This small allowance is specifically to cover bank service fees and maintain the account balance, since client trust funds themselves can't be used for those charges. So this $200 is not considered commingling because it has a legitimate pre-approved purpose. This also highlights that the responsible broker is squarely in charge of supervising all associated firm members and meticulously maintaining these trust accounts.
Okay, $200 for bank fees only. And what about keeping records? How long do you need to hang on to everything?
Record keeping. Absolutely vital for accountability and transparency under California law. Transaction documents and escrow records, and this includes both accepted and rejected offers, must be maintained for a minimum of 3 years from the time of closing or from the date of the listing if the transaction doesn't close. This ensures there's a clear audit trail for the DRE if any questions or complaints arise down the road.
3 years, okay? Really sounds like protecting the consumer is a constant theme woven through all these rules. And for those rare but important instances when things unfortunately go wrong for a consumer, there's that significant safety net you mentioned earlier, the consumer recovery account. You said there are 2 critical numbers here, 2 maximum payouts that people often confuse and practice questions. Let's make sure we untangle those.
Yes, let's do that. The Consumer Recovery Account provides this crucial safety net, offering a path to recourse when a licensee's misconduct causes financial harm. It was specifically created to protect consumers who win a civil suit against a licensee, but then find they're unable to actually collect the damages they're owed from the licensee directly. Maybe the licensee is bankrupt or just vanishes. It's truly a fund of last resort. The 2 maximum payouts are distinct, and it's vital to keep them separate in your mind as they're commonly tested for their precise application. The maximum payout from the account for a single transaction is $50,000. So if one client suffers damages related to one specific property deal, the absolute most they can recover from the fund for that single event is $50,000.
$50,000 or more.
Right. However, the maximum payout from the account for issues related to a single licensee is $250,000. This is regardless of the number of transactions or the number of people that licensee might have harmed. This means if one licensee causes problems across multiple transactions or harms multiple people over time, the total aggregate payout from the fund against that single licensee's misdeeds is capped at $250,000. This is a common area where those 2 numbers get mixed up. Just remember, it's $50,000 per transaction, but never more than $250,000 total out of the fund for any one bad actor.
Okay, $50K per transaction, $250K total per licensee. That makes sense.
Understanding relationships agency, ethics, and fair housing.
All right, here's where it gets really interesting, I think, and sometimes quite complex. Agency relationships. You know, when I first started diving into real estate, the concept of agency was where my brain really started to, well, light up or sometimes get completely tangled. Let's try to unravel that, because it's not just about who works for whom, is it? It feels much deeper than that. Let's start with a foundational distinction. The difference between an agent and a customer in a real estate transaction.
This distinction is absolutely foundational, yeah. And it defines the very nature of the responsibilities owed. An agent in real estate is a license holder who has formed an agency relationship with a principal, who we usually call a client. This means the agent represents that client, and because of that representation, owes them a comprehensive and elevated set of fiduciary duties. These duties represent the highest level of care and trust recognized by law.
Fiduciary duties, okay, the highest level.
Exactly. Now, a customer, on the other hand, is a third party in a real estate transaction with whom the agent has no agency relationship. They're involved. Maybe they're the buyer when you represent the seller, or vice versa. While an agent must always treat a customer with fairness and honesty, they do not owe them that same high level of fiduciary duties that are reserved only for a client. The agent's primary allegiance, their undivided loyalty, is always to their principal.
Okay, so fairness and honesty for everyone, but fiduciary duties only for your client. Makes sense. So what are those fiduciary duties specifically, and how do they change depending on the type of agency relationship? It sounds like there are different levels of authority, almost like different security clearances for an agent.
That's a really good analogy. Different levels of clearance, yeah. There are 3 main classifications of agency, and they're distinguished by the scope of authority or the level of decision-making power granted to the agent. First, special agency. This is the most limited form of agency, and it's definitely the most common one you see in residential real estate. It typically exists between a real estate broker and their client, whether that's a seller or a buyer. First, special agency. In a special agency, the agent is authorized to perform a specific act or transaction, like finding a buyer for one particular property or finding one particular property for a buyer. Crucially, a special agent cannot bind the principal to a contract or agreement without explicit, direct, and specific authorization for that specific act.
So they can't just sign things for you.
Exactly. Think about what binding the principal really means in practice. Your real estate agent, acting as a special agent, cannot just unilaterally sign a purchase agreement on your behalf without your direct, specific authorization for that particular offer. Their authority is very focused. Second, general agency. This grants a broader scope of authority than special agency. A general agent is authorized to manage all of a principal's affairs within a specific area or range of duties. A classic example is a property manager who acts on behalf of an owner for all matters related to managing a rental property. Second, general agency. A general agent can bind the principal in matters within their specified authority, so that property manager acting as a general agent can sign leases with tenants, approve necessary repairs, or even initiate evictions, all on the owner's behalf, because they have a broader, ongoing authority within that specific sphere of property management. It's about how much decision-making power you're delegating within a defined scope.
Okay, broader scope. Can bind the principal in certain areas.
Right. And third, universal agency. This is the broadest form. A universal agent is given the power to act and make decisions on behalf of the principal in practically all business matters of concern. This level of authority is usually granted through a formal power of attorney document. A universal agent can bind the principal in almost any situation, covering a vast array of actions. So to summarize it clearly, general and universal agency relationships come with the authority to bind the principal, granting them significant decision-making power. Special agency typically does not, requiring specific authorization for each major act.
Got it. Special, general, universal, increasing authority. So let's circle back to those core fiduciary duties. What are they again? I know there's an acronym.
Yes, the duties are paramount in any agency relationship you form. And we often remember them with the helpful acronym OLDFAR because these are the essential pillars of an agent's responsibility to their client. Obedience. An agent must obey all lawful and ethical instructions given by their principal. The client is the ultimate decision maker, and the agent carries out their wishes within the bounds of the law. Loyalty. This is often considered the highest duty. It requires the agent to act solely in the best interests of their client, even and especially above their own personal interests or the interests of any third party. It demands undivided allegiance.
Loyalty seems huge.
It is. Then there's disclosure. The agent must proactively reveal all material facts relevant to the transaction to their principal. This ensures the client has all necessary information, positive or negative, to make fully informed decisions. This goes beyond just answering questions. It's about proactively sharing what you know. Confidentiality. Any private information shared by the client must be kept strictly private. This duty is particularly strong and, importantly, lasts forever, even after the agency relationship is terminated or the transaction is closed. What happens in the client-agent relationship stays in the client-agent relationship, legally speaking.
Forever.
Wow, ever. Same for accounting. The agent is responsible for the proper handling of all funds entrusted to them by the client, meticulously keeping records and preventing any commingling of funds. Like confidentiality, this duty also extends beyond the agency agreement and lasts forever. And finally, reasonable skill and care. Agents are expected to apply their expertise and knowledge diligently and competently on behalf of their client. This means acting with the competence that would be expected of a licensed professional in their field.
OLDCAR. Okay, that's a good way to remember them. Can you give a quick example of how this plays out in a real scenario?
Sure. Consider the scenario with broker Petrona. She kept confidential information about buyer Rajabu, but not about seller Marta. What does this tell us? It clearly indicates that Rajabu is her client, to whom she owes the strict fiduciary duty of confidentiality, and all the other OLDCAR duties. Marta, in this case, would be a customer. Petrona still owes Marta honesty and fairness, but not that same elevated level of confidentiality or undivided loyalty that she owes her client, Rajamu. That distinction in how she treated their information reveals the agency relationship.
That makes so much more sense when you frame it like that. Okay, so building on that foundational understanding of how these relationships are structured, it's equally important to understand how they begin and, crucially, how they end. There's a distinction in how they can terminate that often catches people out, I think.
Indeed. And while agency creation can theoretically happen in several ways, like through implied actions or after the fact ratification in California real estate, for a formal, legally enforceable relationship, express written agency is really the only acceptable and reliable way. It protects both the agent and the client by clearly outlining the terms and duties.
So get it in writing. Always.
Always. Now, agency termination falls into two main categories, and understanding the nuances is important for the exam. Operation of law. These are circumstances or changes that automatically terminate the agency agreement, often without regard to the party's desires or actions. It's usually due to forces beyond anyone's control. Operation of law. Examples include the destruction of the specific property, like if a home washes away in a flood, the agency agreement to sell it becomes impossible to fulfill. The death or legal incapacity of either the principal or the agent, though there can be specific nuances for certain lease types, or the bankruptcy of either party. Operation of law. So if Joey's agency agreement ended because the home he intended to purchase was destroyed by a flood, that's termination by operation of law. The subject matter of the contract literally ceased to exist.
Okay, so things outside of anyone's control. What's the other way?
The other way is acts of the parties. This occurs when one or both parties actively take steps to intentionally end the agreement. This is a conscious decision. Examples include mutual rescission, where both the principal and the agent agree, hey, let's just end this. Revocation, where the principal revokes the agent's authority, maybe due to dissatisfaction or just a change of plans. Or renunciation, where the agent chooses to renounce or give up their authority. Maybe they don't want to work with the client anymore. So if Peter terminated his agency agreement because he no longer trusted his broker, that's an acts of the parties termination, specifically revocation of the agent's authority by the principal.
Got it. Operation of law versus acts of the parties. Okay, let's shift gears now to how agents present themselves in their listings to the public. The dreaded advertising rules. They seem stricter and more detailed than some might realize, especially in the digital age.
They absolutely are. The California DRE has clear and pretty stringent guidelines for all forms of advertising, and this definitely extends to online platforms and social media, which are, increasingly important tools for real estate professionals. When advertising online, including on social media, a licensee must include their name, their DRE license number, their license status, like broker or salesperson, and, critically, their responsible broker's license name. This ensures transparency, even in character-limited spaces like maybe a Twitter post or an Instagram bio, so consumers always know who they're dealing with and who the supervising broker is. This is exactly why Katrina's signs, which only listed her name, phone, and license number, were missing crucial information: her responsible broker's license name. That omission makes the ad non-compliant.
So the broker's name is non-negotiable. What about those blind ads?
Right. Blind ads are completely illegal in California. A blind ad is basically one where the licensee attempts to promote real estate activity like selling a property or offering services without clearly disclosing that they are a licensed professional. This prevents consumers from being misled into thinking it's maybe a private sale, FSBO, or that they are dealing with an unlicensed individual. Transparency is key.
Makes sense.
Yeah.
And what about using different names, like DBAs or team names?
Good point. There's an important distinction there. A fictitious business name, often called a DBA or doing business as, is an alternative name a broker uses for their business, something different from their own legal name. This requires formal DRE approval. A salesperson can also get a DBA with their broker's explicit permission and DRE approval, but any advertising under this DBA must still include the salesperson's legal name, license number, and the responsible broker's identity. There's no limit to how many DBAs a broker can have, but they can't be misleading, like implying a partnership if none exists, or include a salesperson's name without proper disclosure. Team names, on the other hand, are professional identities used by two or more associated licensees working together, like the Smith team or the Jones Group. These do not require DRE submission for approval, as they operate under the responsible broker's primary license. However, team names must include the surname of at least one team member and a word like team, group, or associates. They cannot use terms like broker or brokerage that might suggest they operate independently from a responsible broker. Interestingly, terms like realty and real estate are allowed within a team name. And just like DBAs, advertisements for team names must clearly display the team name, the surname, and license number of at least one team member, and of course, the responsible broker's license name. It's all about ensuring that clear line of accountability back to the broker.
Okay, lots of rules around names and disclosure there. Now let's dive into some hot-button issues that protect competition and ensure fairness for everyone in the market. Antitrust laws. These aren't just abstract legal concepts. They directly impact how real estate professionals have to operate ethically, right?
Oh, absolutely. This is a critical area for maintaining a fair and competitive marketplace, protecting both consumers and ethical businesses. Antitrust laws are specifically designed to prevent unfair anti-competitive practices like price fixing, collusion, and monopolies, things that stifle competition and ultimately harm the public. Let's break down some common violations that real estate professionals must be acutely aware of. First, price fixing. This is an absolutely illegal effort by competitors to jointly establish a fixed rate, price, or commission. For example, if Lannish, Charlie, and Lucy, all agents working for different brokerages in the same town, get together over coffee and agree, hey, let's all set our commission rates in a similar higher range, maybe 3% for buyers and 3% for sellers, that is illegal price fixing. It's a conspiracy to eliminate competition on price.
So no agreeing on rates between brokerages.
Correct. However, it's crucial to understand that discussing commission splits for a specific transaction between, say, a listing agent and the buyer's agent working on that one deal is permissible and not considered price fixing. That's a legitimate negotiation related to a single deal, not a market-wide agreement on rates. Second, bid rigging. This occurs when competitors conspire to choose the winner of an auction or to manipulate prices before an auction even begins. For instance, if Will McFarland and Ja Rule, both real estate agents or investors, go to a foreclosure auction and secretly agree beforehand, okay, Will, you bid on house A, Ja Rule, you bid on house B, and we won't compete for each other's chosen properties, all with the goal of keeping prices artificially low. They are engaging in illegal bid rigging.
Wow, that sounds seriously shady.
It is. And third, group boycott. This is an agreement between two or more competitors to not do business with another competitor. The goal is typically to force that competitor to change their business practices or, worse, to drive them out of business entirely. For example, if Scrooge, maybe a dominant broker in a market, persuades all the agents from other brokerages to stop using a particular advertising firm because he wants that firm to lower its prices, he is organizing an illegal group boycott. This limits consumer choice and stifles smaller businesses.
Okay, those are definitely things to avoid. Equally crucial, though, are the laws that ensure everyone has a fair shot at housing, regardless of who they are. Let's talk about fair housing. What are the key elements, and what's that very important distinction between the Fair Housing Act and the Americans with Disabilities Act when it comes to things like modifications and accessibility? That seems to trip people up.
Fair housing laws are absolutely paramount for ensuring equal access to housing opportunities for everyone. Let's start with a bit of historical context, because it's important for understanding their evolution. The Civil Rights Act of 1866 unequivocally prohibited discrimination based on race or color in all property transactions. This act became broadly enforceable after the landmark Supreme Court case Jones v. Mayer in 1968, which basically ruled that all racial discrimination in housing was unconstitutional, made it illegal to refuse to sell or rent to someone based on race, period, anywhere.
1866? Wow, that's fundamental.
It is. Then the Fair Housing Act, FHA, of 1968 further expanded these protections to include not just race and color, but also religion, national origin, sex, disability, and familial status. The FHA primarily applies to residential dwellings and related transactions like sales, rentals, and financing. Now, here's that common point of confusion for exam takers. Distinguishing the FHA from the Americans with Disabilities Act, ADA, which was passed in 1990, the ADA has a different scope. While both address disability, the ADA primarily applies to employment, public accommodations, and commercial facilities, not usually residential housing itself. It sets accessibility standards in public spaces. So if you see wheelchair ramps and grab bars in a public restroom, at a shopping mall, or maybe inside a state capitol building, those are examples of compliance with the ADA, the Americans with Disabilities Act.
Okay, ADA for public places.
Right. However, if these modifications, like a wheelchair ramp, were made in a residential building for a tenant, the Fair Housing Act, or FHA, would be the governing law. The FHA requires landlords to allow reasonable modifications for disabled tenants, at the tenant's expense usually, but the landlord can't unreasonably refuse. It also requires landlords to make reasonable accommodations in rules or policies, like allowing a service animal even if there's a no pets policy, provided it doesn't pose an undue burden or direct threat.
Reasonable modifications and accommodations. Got it.
And the FHA also defines disability pretty broadly. It's not just about a current physical or mental impairment, but also having a record of such impairment or even being regarded as having such an impairment. So a person like Ajit, who maybe has a history of major depression but isn't currently suffering from it, can still qualify as having a disability under federal law and be protected. Furthermore, familial status is another key protected class under the FHA. This broadly includes pregnant women, families with children under 18, and individuals in the process of securing legal custody of children. So a landlord who refuses to rent to a pregnant couple because they're worried a screaming baby might upset the neighbors is in direct violation of fair housing legislation due to discrimination based on familial status. You can't discriminate based on family makeup.
It's a really important protection.
It is. Finally, let's quickly define some specific discriminatory practices that are unequivocally illegal in real estate. Blockbusting, sometimes called panic peddling, is the illegal act of causing owners to sell their homes, often at a loss, by creating fear that members of a protected class are moving into the area and will supposedly decrease property values. It's basically preying on prejudice for profit. Redlining is when a lender illegally refuses to issue mortgages or provide other financial services in specific geographic areas, often based on the racial or ethnic makeup of that area. It's like drawing red lines on a map to avoid lending in certain neighborhoods. Steering, also called channeling, is the illegal act of guiding prospective home buyers towards or away from certain neighborhoods, specifically because of their membership in a protected class, like race, religion, etc. This limits their housing choices based on discriminatory motives.
Those all sound terrible. How should an agent handle it if a client says something discriminatory?
That's a critical question. Agents must provide equal services to everyone, period. If a client asks a discriminatory question, like about the racial makeup of a neighborhood or the ethnic background of potential neighbors, an agent should never answer that question directly or go along with any discriminatory acts or speech. A recommended professional response is something like, "It is the policy of our company not to answer questions of that nature. Housing choices should be based on the property itself. If you have concerns about neighborhood demographics, you are free to research publicly available resources on your own." This clearly communicates the agent's ethical boundaries and commitment to fair housing laws without being preachy or judgmental, and it puts the onus for potentially discriminatory research back on the client.
That's a good professional way to handle a tough situation.
The world of money, real estate, finance, and loan mechanics.
Okay, so we've navigated the legal guardrails and the ethical obligations. But let's face it, at the heart of most real estate transactions is the flow of capital, the money. Moving from laws to loans, let's explore the financial plumbing of real estate, starting with the big players. What are the two major markets that make up real estate finance, and who are the key entities that make them,
Right. The mortgage market operates on this critical two-tiered structure that ensures a continuous and dynamic flow of capital for real estate deals. Understanding this is really key to grasping how loans are funded and sustained over time. First, you have the primary mortgage market. This is where borrowers like you and me and lenders directly interact to negotiate loan terms and actually originate the mortgages. This is where you go to get your loan from institutions like commercial banks, credit unions, savings and loans, and mortgage bankers. Mortgage bankers specifically often control the largest share of this market. They originate loans using their own funds or funds they've borrowed, rather than just relying on depositor funds like a traditional bank might. They act as these direct conduits for loan creation.
Okay, primary market is where the loans start. What's the other one?
The other tier is the secondary mortgage market. This is where those mortgages that were originated in the primary market are subsequently bought and sold. Its purpose is absolutely crucial for the whole system. It allows primary lenders to replenish their capital. They sell off the loans they've already made to investors. This process is often called reloading on capital, and it frees up their funds so they can turn around and originate more new loans. Without this secondary market, primary lenders would pretty quickly run out of money to lend, which would basically bring the entire real estate market to a grinding halt. So this market provides essential liquidity.
So the secondary market keeps the money flowing back to the primary lenders so they can keep lending. Who are the big players buying these loans?
The major players in the secondary market are these powerful government-sponsored enterprises, or GSEs, and one key government-owned entity, Fannie Mae. That's the Federal National Mortgage Association, FNMA. This GSE buys and securitizes loans, specializing mostly in purchasing conventional loans from large commercial banks. It provides stability and liquidity to that conventional mortgage market. Freddie Mac, the Federal Home Loan Mortgage Corporation, FHLMC. Freddie Mac is similar to Fannie Mae in its function, but it traditionally specialized in purchasing loans from smaller thrift banks, like savings and loans associations. It also enhances liquidity, particularly for those types of lenders. Ginnie Mae, the Government National Mortgage Association, GNMA. Now, Ginnie Mae is unique because it's a government-owned entity, not a GSE like Fannie or Freddie. It focuses on buying loans that back government housing assistance programs like FHA and VA loans. Critically, its mortgages are backed by the full faith and credit of the U.S. government, which provides a stronger guarantee and lower risk for investors.
Ah, so Ginnie Mae has that full government backing. Interesting.
Exactly. And then there's also Farmer Mac, the Federal Agricultural Mortgage Corporation. This GSE focuses specifically on agricultural loans, providing liquidity to that vital sector, helping farmers and rural homeowners secure financing. All these entities facilitate the creation of mortgage-backed securities, MBS. These are basically investment instruments that have pools of mortgages as their underlying collateral. Investors buy a stake in these diverse pools of mortgages, and that provides continuous capital back into the housing market.
Okay, that market structure makes sense. And speaking of the big picture, the Federal Reserve, with the Fed, seems to pull a lot of strings when it comes to interest rates and the overall economy. How exactly do they do that, and what's the ripple effect on real estate?
Right. The Fed's role is crucial. They influence and manage the United States monetary policy, aiming to stabilize the economy by controlling the money supply and credit conditions. They have three primary tools, and each has a significant ripple effect on real estate. First, raising or lowering interest rates. Specifically, the Fed influences the federal funds rate, which is a target rate for overnight lending between banks. When the Fed lowers this rate, it generally makes borrowing cheaper across the whole economy. This tends to stimulate economic activity, encourage spending, and make mortgages more affordable. Conversely, raising interest rates makes borrowing more expensive, which slows down the economy, often to combat inflation, and typically leads to higher mortgage rates, which can cool off a hot housing market.
So the Fed rate directly impacts mortgage rates, usually.
Usually, yes, though not always one-to-one. Their second tool is reserve requirements. These are the amounts of money banks must hold in reserve rather than lending out. If the Fed increases reserve requirements, it reduces the money banks have available to lend, tightening credit and slowing the economy. Decreasing them frees up more money for lending, stimulating the economy, and potentially making more funds available for mortgages. This tool isn't used as often, though. Their third and most frequently used tool is open market operations. This involves the Fed buying or selling government securities, like Treasury bonds, on the open market. When the Fed buys securities from banks or investors, it injects money into the banking system, increasing the money supply and typically pushing interest rates down. This makes mortgages cheaper. When it sells securities, it takes money out of circulation, reducing the money supply and typically pushing interest rates up, making mortgages more expensive. The third and most frequently used tool is open market operations. These open market operations directly influence the availability and cost of money throughout the entire economy, very much including the real estate market.
Okay, interesting how those tools work. Now let's talk about the different kinds of loans you'll actually encounter and some of their key features.
Yeah.
For example, what makes a conventional loan conventional? What may be surprising about them?
A conventional loan is, pretty simply, any loan that is neither insured nor guaranteed by the government. That's the core definition. Many people assume conventional implies something strict or standard, but its main meaning is just the absence of government backing like you'd find with FHA or VA loans. Because the lender is taking on more risk directly without that government backing, conventional loans often have stricter credit and income requirements than government-backed loans.
And what about PMI that comes up with conventional loans, right?
Yes. Private mortgage insurance, PMI, is a very common requirement for conventional loans, and it's definitely a point of frequent confusion. For instance, if Mindy gets a conventional loan, she will likely be required to purchase PMI if her loan-to-value LTV ratio is 81% or more. That basically means her down payment was less than 20%. Maybe she put down only 5% or 10%. It's absolutely vital to remember that PMI is insurance paid by the borrower, but its purpose is to protect the lender, not the borrower, in case the borrower defaults on the loan. It helps lenders feel comfortable making these higher LTV loans without taking on excessive risk.
So PMI protects the lender, even though the borrower pays for it. Got it.
What about IARMs, adjustable rate mortgages? Right. Another common loan type is the adjustable rate mortgage, ARM. Unlike a fixed rate loan where the interest rate stays the same for the entire loan term, like 30 years, the interest rate on an ARM fluctuates periodically based on a specified market index, like maybe the LIBOR rate or the prime rate. The loan will have a fixed margin, that's a percentage added to the index, which remains constant throughout the loan, and often various rate caps. These caps limit how much the interest rate can change in a single adjustment period, say annually, and also over the loan's entire lifetime. Some even have payment caps. Before someone takes on an ARM, they absolutely must carefully consider whether they can truly afford the maximum possible monthly payment if the interest rates hit their ceiling or lifetime cap. That represents the greatest financial risk with an ARM, and it's a critical point for buyers to understand and budget for.
That maximum payment is definitely the scary part of an ARM. And subprime loans.
Yeah, subprime loans are also a type of mortgage, but they generally come with higher interest rates and often less favorable terms. They're typically offered to borrowers with lower credit ratings or maybe a more challenging financial history, reflecting the increased risk the lender perceives due to the borrower's creditworthiness.
Okay. Now, this next concept often causes a lot of confusion. The difference between lease theory and title theory estates and how California fits into that.
Yeah.
You mentioned it affects how foreclosures work, which is pretty significant.
Yes, this distinction is fundamental to understanding how property ownership is viewed legally in relation to a mortgage loan. And you're right, it directly impacts the foreclosure process. In a lien theory state, the borrower retains legal title to the property throughout the entire loan term. The lender, instead of holding the title deed, simply places a lien on the property. Think of it like putting a claim or an encumbrance on the property that ensures the debt gets paid back. The relationship primarily involves just two parties. The mortgagor, that's the borrower who holds the title, and the mortgagee, that's the lender who holds the lien. Foreclosures in lien theory states typically involve more formal judicial proceedings, meaning a lawsuit and court process is usually required to foreclose, which can be a longer and more expensive process for the lender.
So lien theory. Borrower keeps title, lender gets a lien, foreclosure usually goes through court. What about title theory?
In a title theory state, it's different. The legal title to the property is actually conveyed to the lender, or more commonly to a third-party trustee who acts on behalf of the lender right at the inception of the loan. This title is held by the trustee until the debt is fully paid off. Essentially, the trustee holds it in trust for both the borrower and the lender. This structure involves three parties. The trustor, that's the borrower who gives the title to the trustee, the beneficiary, that's the lender, who benefits from this trust arrangement, and the trustee, the neutral third party who holds the legal title. A unique trait of title theory states is that it's generally easier and faster for lenders to file for non-judicial foreclosure if a borrower defaults. This is because of something called a power of sale clause, which is typically included in the deed of trust document. This clause pre-authorizes the trustee to sell the property without needing a court order if the borrower defaults on the loan.
Okay, title theory. Trustee holds title, non-judicial foreclosure is easier. So where does California fit? It's confusing.
It is confusing, and it's a classic exam point. Here's California's unique position. While California is technically classified as a lien theory state by law, its preferred and most commonly used security instrument is the deed of trust, not a mortgage. Because the deed of trust involves that third-party trustee holding the title, much like in a title theory state, California operates in practice very similarly to a title theory state, particularly regarding the ability to conduct those faster, non-judicial foreclosures using the power of sale clause. So while the underlying legal theory for California is LINA, the practical application leans heavily towards the title model due to the widespread use of deeds of trust. This allows for quicker foreclosure methods when necessary, which lenders generally prefer.
So technically LINA, but acts like title because of the deed of trust. That's the key takeaway.
Exactly. Now, regardless of whether a state is lien or title theory, a single mortgage loan typically involves two core documents that work hand in hand: the promissory note and the security instrument. The promissory note. This is the borrower's written promise to pay back the debt. It's the evidence of the debt itself and outlines all the crucial loan terms, the specific amount borrowed, the interest rate, the repayment schedule, and where and when payments are due. It's basically the IOU of the transaction, the promissory note. It's also a negotiable instrument, which means it can be transferred or assigned to another party. This is what allows loans to be readily bought and sold in that secondary market we discussed earlier.
The note is the promise to pay. What's the other document?
The security instrument. This document pledges the property itself as collateral or security for the promissory note. In California, this is typically the deed of trust. In other states, it might be a mortgage. This is what allows lenders to offer lower interest rates because their investment is secured by the tangible asset of the property itself. Without this collateral pledge, lending would be far riskier and much more expensive for borrowers. So, for example, Ricky's loan, having both a promissory note and a security instrument, like a deed of trust, means the note serves as evidence of his debt and its terms, while the deed of trust identifies the specific property that's collateralizing that note. Key clauses you often find within these instruments include the acceleration clause, which allows the lender to demand the entire outstanding loan amount become immediately due and payable upon default, like missing several payments, and the right to reinstate clause, which gives a borrower a specific window of time to cure their default, usually by bringing all missed payments and fees current, and halt the foreclosure process, allowing them to continue with the original loan terms as if no default had occurred.
Okay, note and deed of trust work together. Now, beyond the loan itself, there are those crucial regulations designed to protect consumers throughout the financing process. It's all about ensuring transparency and preventing hidden surprises, isn't it?
Absolutely. Transparency and fairness are really paramount in consumer finance protection. The Truth in Lending Act, TILA, which is implemented by the Federal Reserve's Regulation Z, is designed specifically to protect consumers by requiring lenders to provide clear and consistent loan cost information. This enables borrowers to comparison shop effectively between different loan offers. Regulation Z has very specific rules for advertising. Certain trigger terms in an advertisement, like mentioning the monthly payment amount, the number of payments, the amount of a down payment, like saying down payments as low as $10,000, the amount of any finance charges, or the total loan terms will activate or trigger the requirement for full disclosure. This means the ad must then also include additional information, like the cash price, the total required down payment, the total of all payments over the life of the loan, and very importantly, the annual percentage rate, APR. The APR reflects the true annual cost of the loan, including most fees and points, making it a better comparison tool than just the interest rate alone.
So certain terms in an ad trigger the need for much more detail. What about the right of rescission?
Right. Regulation Z also provides for a very specific protection, a right of rescission. This is a 3-business-day period during which a borrower can cancel certain types of loans with no questions asked and no penalties. However, and this is a very important nuance and a frequently misunderstood point, often tested, this right only applies to loans where already owned homes are used as collateral. Think refinancing loans, home equity lines of credit, HELOCs, or second mortgages. It does not apply to loans used to purchase a new home or for construction loans on a new build. So Antoine's home equity loan, therefore, correctly triggers this right to rescind, giving him that 3-day cooling-off period to change his mind if needed.
Okay, only for loans on homes you already own, like refis or HELCs, not purchase loans. Good distinction. What about RESPA?
The Real Estate Settlement Procedures Act, RESPA, is another critical consumer protection law. Its main purpose is to protect consumers from abusive lending practices and unnecessarily high costs during the real estate settlement or closing process. RESPA prohibits kickbacks and unearned fees for referrals for closing services. This ensures that professionals, like lenders or title agents, aren't simply recommending certain service providers just because they're receiving a hidden fee for the referral. Disclosure is key. It also sets strict rules for the management of escrow accounts used to pay property taxes and insurance, limiting how much of a cushion lenders can require borrowers to keep in those accounts.
No kickbacks, rules for escrow. Got it. And Dodd-Frank.
Finally, while it's not a regulation you deal with daily like TILA or RESPA, it's worth noting the Dodd-Frank Act. This was a truly monumental piece of legislation passed directly in response to the profound impacts of the 2008 financial crisis. Its sheer scale aimed to overhaul financial regulation across the board. One of its most lasting and impactful legacies was the creation of the Consumer Financial Protection Bureau, CFPB. This agency now acts as a primary watchdog, specifically tasked with protecting consumers in the financial marketplace. It gives consumers a dedicated advocate against predatory practices and works to ensure transparency in all types of financial products, definitely including mortgages. It really centralized and strengthened consumer protection oversight.
The CFPB came from Dodd-Frank.
Yeah.
Okay. And for those unfortunate situations where lenders do take advantage, we need to be able to spot the warning signs of predatory lending. It seems crucial for protecting clients.
It's absolutely a crucial skill for any real estate professional, because predatory lending can be absolutely devastating for borrowers, often targeting vulnerable populations. Predatory lending basically involves unfair, deceptive, or fraudulent practices by lenders, often resulting in abusive loan terms imposed on borrowers who may not fully understand them or have other options. The key red flag to watch out for, the thing that often signals predatory lending, is the appearance of unexpected, undisclosed lender fees that suddenly appear at closing. Now, while subprime loans might legitimately have higher interest rates and fees due to borrower risk, those should typically be disclosed up front. The predatory element often comes from the surprise or hidden nature of charges that weren't part of the initial agreement or disclosure, often tacked on at the very last minute when the borrower feels pressured to close.
Surprise fees at closing, big red flag. Are there other common tactics?
Yes, other common predatory practices include things like equity stripping. This is where a lender makes a loan based primarily on the homeowner's equity, knowing the borrower likely can't afford the payments, with the underlying goal of seizing the home through foreclosure to capture that equity. Bait and switch. Advertising a very favorable loan rate or term to lure a borrower in, then at the last minute switching them to a much worse loan. Loan flipping. This involves repeatedly refinancing a loan over a short period, with each refinance generating new fees and potentially higher interest rates without providing any real financial benefit to the borrower. It just racks up costs. Packing. Including unnecessary or excessive fees for services the borrower doesn't need or want, like overpriced credit insurance, into the loan amount. Hidden balloon payments. Structuring a loan to make the monthly payment seem affordable, but disguising the fact that a large unexpected lump sum payment, the balloon, will be due at the end of the term, which the borrower may be unable to pay. Hidden balloon payments. Being able to identify these red flags is really critical for protecting your clients from financial harm.
Definitely good to know what to watch out for. Okay, let's transition to some of those specific math questions that can feel like real stumbling blocks on an exam. These are the kinds of calculations that can really trip you up if you don't have a solid grasp of the formulas. First up, simple interest on a non-amortized loan.
Okay, let's break this down step by step, as these are very common calculations. Let's use Nick's example. He took out a non-amortized loan of $100,000 at a 5.3% annual interest rate, and we need to find the interest he pays over 3 months. Remember, a non-amortized loan means he's only paying interest during this period, not any principal. First, calculate the annual interest. You multiply the principal by the annual interest rate. First, calculate the annual interest. So $100,000, 0.053 equals $5,300 in annual interest. Since we need the interest for just 3 months, we'll find the monthly interest first, then multiply by 3. So divide the annual interest by 12. 5,312 equals 441.666 per month. Let's round that to $441.67 for practical purposes. Then multiply the monthly interest by the number of months. $441.67 divided by 3. We can probably round that to $1,325 for the exam. Then multiply the monthly interest by the number of months. So Nick will pay $1,325 in interest over those 3 months, and the full $100,000 principal would likely be due as a balloon payment at the end of the loan term.
Okay, annual interest, divide by 12, multiply by months. Got it. Now, another common one that trips people up is the VA loan guarantee amount. It's a common misconception, isn't it, that the VA just hands out a check for $36,000 for every loan. As you laid out, it's much more strategic and based on a percentage.
That's a critical clarification, yeah, and you're right. The $36,000 figure is widely misunderstood. It's so important to remember that the VA does not lend money. It guarantees a portion of the loan made by approved private lenders. This guarantee protects the lender in case the veteran defaults, which in turn encourages lenders to offer more favorable terms, like no down payment, to eligible veterans. The general rule is that the VA guarantees 25% of the loan amount up to the conforming loan limit set for that county by the FHFA, which varies. That $36,000 is often cited as a basic or minimum entitlement amount, but it's not the universal guarantee on every loan. So, for example, if a veteran takes out a $200,000 VA loan and they have their full entitlement available, the VA would guarantee 25% of that amount, which is $50,000. Similarly, if Max took out a $260,000 VA loan with his full entitlement, and assuming that amount is below the conforming loan limit for his area, the VA would guarantee 25% of $260,000, which is $65,000. So the actual guarantee amount can be much higher than that basic $36,000, depending on the loan size and the veteran's specific available entitlement.
25%, up to the limit. That's the key. Okay. How about figuring out the total cost of an amortized loan? Max Loan's a good example.
Right.
The monthly payment might look manageable, but the total number over time can be quite surprising.
Yeah, finding the total cost of an amortized loan is straightforward multiplication, but it really highlights the long-term cost of borrowing. You simply multiply the fixed monthly payment, principal and interest, by the total number of payments over the entire loan term. This calculation reveals the full amount of principal and interest the borrower will pay over the life of the loan. In Mac's example, he makes monthly payments of $6,050.25 on a 15-year loan. First, figure out the total number of payments. 15 years x 12 months per year equal 180 monthly payments. In Mac's example, he makes monthly payments of $6,050.25 on a 15-year loan. First, figure out the total number of payments. So his total cost for the loan is $6,050.25 on 180s, $1,089,045. That's the grand total he will pay over those 15 years for that loan. Quite a bit more than the original loan amount due to interest.
Over $1 million. Wow. Okay, and finally, a classic calculation that always seems to show up at closing, prorated HOA dues. How does that work?
Let's break down that prorated HOA dues calculation. Yeah, because prorations are a fundamental part of closing statements, allocating expenses between buyer and seller. Let's say the annual HOA dues are $2,460, and the seller has paid for the full year up front. The buyer is taking possession with exactly 3 months left in that year. The buyer will need to reimburse the seller for those 3 months that the seller already paid for but won't be living there. First, find the monthly cost of the HOA dues. $2,460 divided by 12 months equals $205 per month. Then, multiply that monthly cost by the number of months the buyer will be in possession during the period the seller prepaid. $205 at 3 months gives $615. Then, multiply that monthly cost by the number of months the buyer will be in possession during the period the seller prepaid. This $615 would typically appear as a debit to the buyer, meaning they pay this amount at closing, and a credit to the seller, meaning they receive this amount back on the closing statement. It's just squaring things up fairly.
Debit buyer, credit seller for the unused portion. Makes sense. Could we do another quick proration, maybe with property taxes? They often work differently.
Absolutely. Let's do property taxes, which are often paid in arrears at the end of the period. Say the annual property tax bill is $8,625, and it's typically paid at the end of the year. The close of escrow is November 15th. We need to figure out how much the seller owes for the portion of the year they occupied, because the buyer will likely pay the full bill when it comes due. Let's assume the buyer owns the day of closing. We'll use a 360-day year, banker's year, for simplicity, meaning each month has 30 days. First, calculate the daily tax cost. $8,625, 360 days equals 23.9583 cents per day. Let's call it $23.96 per day. First, calculate the daily tax cost. The seller occupied the property from January 1st through November 14th, since the buyer owns the 15th. How many days is that? 10 full months. Jan Oct is 1030 equals 300 days. Plus 14 days in November. So 300 plus 14 equals 314 days. Now multiply the daily cost by the number of days the seller occupied. $23.96 take 314 days. It would be a debit to the seller. They owe this for their time. The $7,523.44 would be a debit to the seller. They owe this for their time. And a credit to the buyer, who will eventually pay the full bill on the closing statement.
Okay, calculating daily rate and multiplying by seller's days. That clarifies tax prorations. One more calculation. First monthly interest on an amortized loan, like Bruce's. Why is that first month special?
Calculating the interest portion of the first payment on an amortized loan is a common test question because it confirms you understand how amortization works right from the start, when the principal balance is at its highest. Bruce has a $300,000 amortized loan at a 5.2% annual interest rate. His total monthly P&I payment is $1,647.33. To find just the interest portion of his very first monthly payment, you use the full original principal balance because no principal has been paid down yet. First, calculate the annual interest on the full principal, $300,000, so 0.052 equals $15,600. Then divide that annual interest by 12 to find the amount of interest due for the first month. $15,600, 12 equals $1,300. Then divide that annual interest by 12 to find the amount of interest due for the first month. So out of his first payment of $1,647.33, exactly $1,300 goes towards interest. The remaining part of his payment, $1,647.33, $1,300, $337.33, goes towards reducing his principal balance. Then divide that annual interest by 12 to find the amount of interest due for the first month. This reduction in principal with each payment is the core idea of amortization. In the second month, the interest calculation would be based on a slightly lower principal balance, so slightly less interest would be due, and slightly more would go to principal, and so on.
So first month's interest is based on the full loan amount.
Got it. Owning the land property use, taxation and transfer.
All right, so we've deep dived into the legal framework and the often intricate world of real estate finance, but at the heart of real estate, quite literally, is the land itself. Our next section is all about the fundamental government powers that govern what you can actually do with that land, how it's taxed, and ultimately how ownership changes hands. These are really the bedrock principles of property ownership that you'll encounter constantly, both on the exam and definitely in practice.
That's exactly right. These government powers over private land are absolutely foundational, and they're often remembered by that helpful acronym PEAT. police power, eminent domain, taxation, and escheat. These represent the four primary ways the government can control, benefit from, or, in some rare cases, even take private land, all theoretically for the public good.
Pete. Okay. Let's focus first on police power, particularly zoning.
Yeah.
What's the key thing to understand about zoning changes and maybe existing businesses that don't fit the new rules?
Right, police power. This is the government's inherent right to regulate and restrict the use of private land to protect the public's health, safety, and general welfare. It's a very broad power, and it's constantly evolving. Zoning is a primary example of this power in action. It involves the division of land within a city or county into separate districts, each with specific rules about permitted, prohibited, or conditionally allowed uses like residential, commercial, industrial, or agricultural zones. Building codes, which set detailed standards for construction safety and materials, also fall squarely under police power. Now, a non-conforming use is a situation where an existing property use was perfectly legal when it started, but it's now inconsistent with the current zoning regulations because the rules changed. These are typically allowed to continue, often because of a grandfather clause or because they have a pre-existing legal status.
So they get grandfathered in.
Yeah.
What happens if the business changes or sells? Can it become illegal then? That seems like a common point of confusion.
Yes, exactly. This is where it gets tricky and often appears in practice questions. When a non-conforming use changes hands, or more importantly, changes its type of business, it can potentially become an illegal non-conforming use. Let's use the Tina and Al donut dumpling shop example. Imagine Tina's charming old corner donut shop. It's been there for decades. Then, the city rezones the entire block for strictly single-family residential homes. Boom, Tina's shop is now non-conforming. It doesn't fit the new residential zoning. The city might let Tina keep selling donuts because her business was there first. This permission might be formalized as a grandfathered status, or maybe she obtained a specific variance or conditional use permit allowing her existing donut business to continue despite the zoning change, perhaps arguing economic hardship if forced to close. But here's the critical part. If Tina sells the property to Al, and Al decides to open up, say, a loud late-night dumpling bar in that same space, even though it's still a commercial use, the city is very likely going to step in and say, hold on, that's a new and different non-conforming business. Your permission, or Tina's permission, was likely specific to the donut shop, or maybe the hardship related to that specific use. The special permission, like a variance, usually doesn't automatically transfer to a new type of non-conforming use, nor does it automatically run with the land for any different business. Variances, in particular, are often granted based on unique physical characteristics of the property itself that make strict compliance with zoning unreasonably difficult, like odd lot shape, not just the owner's business preference. So Al's new dumpling business, because it deviates from the current residential zoning and the specific nature of the prior non-conforming use or variance, would likely be considered an illegal non-conforming use and wouldn't be allowed.
So the permission is often tied to this specific original use or property hardship, not just any commercial use. That distinction really clears up why a seemingly similar business might not be allowed.
Okay, so what about the government's power to simply take private land, even if the owner doesn't want to sell? That sounds pretty impactful.
That's eminent domain. It's the government's inherent power to seize private property, but only for public use, and only provided they pay the property owner just compensation. Just compensation generally means the fair market value of the property being taken. This power is balanced, acknowledged, and limited by the Fifth Amendment of the U.S. Constitution. The actual process through which the government exercises this power of eminent domain is called condemnation. Common examples of public uses include building highways, schools, public hospitals, parks, or installing necessary public utilities like power lines or water pipes. It's a significant power, generally used judiciously, but it's fundamental to developing public infrastructure. Condemnation is the process. Eminent domain is the power.
Got it. And we definitely can't forget taxes, a big, often unavoidable part of real estate ownership.
Indeed. Property taxes are technically ad valorem taxes, which is just a fancy way of saying they're calculated based on the assessed value of the real estate, not based on its income or sales price. In California, the very famous Proposition 13, passed by voters way back in 1978, significantly limits how much real property taxes can increase. It generally caps the basic property tax rate at 1% of the property's full cash value. Usually it's assessed value at the time of purchase or new construction, plus any additional amounts for local bonds or special assessments that voters specifically approve. Prop 13 has had a profound, long-lasting impact on California property values and the state's tax structure.
Prop 13 limiting tax increases.
Right.
What happens if you don't pay your property taxes? If property taxes go unpaid for long enough, it can eventually lead to a tax sale, where the county tax collector sells the property to satisfy the delinquent taxes owed. However, California provides a significant protection for homeowners. Delinquent taxpayers have a generous 5-year right of redemption. During this 5-year period, the original owner can repurchase the property by paying all the owed back taxes, plus interest, penalties, and any costs incurred by the county. This right exists before the property is actually conveyed to a new owner via a tax deed at a tax sale. So there's a substantial grace period for owners to try and recover their property.
5 years to redeem. That's quite a while. What about capital gains?
Right. From a broader tax perspective, especially if you're dealing with investment properties, it's important to understand capital gain and capital loss. A capital gain is simply the increase in the value of an asset, like real estate, from the time it was purchased to the time it was sold. Crucially, a capital gain is realized for tax purposes only when the asset is actually sold, not merely when its value increases on paper while you still own it. Conversely, a capital loss is the deficit amount incurred when you sell a capital asset for less than its adjusted purchase price. Understanding gains and losses is important for calculating potential tax liabilities when a property is sold. And don't forget the documentary transfer tax. This is a one-time state and sometimes local tax that must be paid when property ownership is transferred from one owner to another, typically handled at the close of escrow. It's usually calculated based on the sales price of the property.
Okay, capital gains realized on sale and the transfer tax at closing. Got it. Finally, let's tie this all together with how property ownership is fundamentally transferred. What's the critical difference between a deed and title? That seems like another one people often confuse.
Yes, it's a very common point of confusion, but vital to clarify, as they sound similar but represent very different concepts. Title is the abstract concept of ownership rights. It refers to someone's legal ownership interest and their right to possess, use, and dispose of a specific piece of real property. You hold title, you have title, but it's not a physical document you can hold in your hand. It's really the bundle of legal rights associated with ownership.
Title is the concept, the rights.
Exactly. A deed, on the other hand, is the physical legal document that actually transfers that title, those ownership rights, from one party, the grantor, to another party, the grantee. It's the written instrument, the piece of paper that formally conveys those ownership rights. Now, while California law doesn't technically require a deed to be recorded in public records for it to be legally valid between the immediate parties, the grantor and the grantee who signed it, an unrecorded deed can be invalidated by later recorded deeds. For example, if a dishonest seller sells the same property twice, the second buyer who records their deed first, without knowing about the first unrecorded sale, might end up with superior legal title. Therefore, recording a deed promptly in the county public records is always the best practice. It provides constructive notice to the entire world of the new ownership and protects the new owner's interest against future claims.
So record your deed ASAP. What kinds of deeds are there?
There are several main types of deeds, and each offers different levels of guarantee or promises called covenants, from the grantor to the grantee about the state of the title. A warranty deed provides the strongest guarantee of good title. The grantor makes several covenants to the grantee, essentially promising that the title is clear and protecting the grantee against future claims from anyone. While strong, these aren't as common in California as the next type. A grant deed is the most commonly used deed in California. It offers more limited guarantees than a warranty deed. With a grant deed, the grantor implicitly warrants two things. First, that they have not already conveyed the property to someone else, and second, that the property is free of any encumbrances, like liens or easements, made by the grantor or anyone claiming under them, unless disclosed in the deed. It doesn't warrant against claims from before the grantor owned it. A grant deed is the most commonly used deed in California. It offers more limited guarantees than a warranty deed. With a grant deed, the grantor implicitly warrants two things. The quitclaim deed conveys whatever interest the grantor may have in the property at that time, but it offers absolutely no guarantees or warranties about the actual ownership or the presence of any encumbrances. The grantor is basically saying, whatever I own, if anything, I'm giving it to you, but I'm not promising I own anything. These are often used to clear up potential clouds on a title, like resolving a minor boundary dispute, or perhaps transferring property between family members where formal warranties aren't deemed necessary. A grant deed is the most commonly used deed in California. It offers more limited guarantees than a warranty deed. With a grant deed, the grantor implicitly warrants two things. And just to reiterate, it's important to note that a bargain and sale deed, which is used in some other states, is not used in California.
Great deed is the main one in California. Okay. And the process that often facilitates this whole transfer, holding the documents and money, that's escrow.
Yeah.
Can brokers handle that?
Exactly, that's escrow. Escrow is a process where an uninvolved, trusted, neutral third party, the escrow holder, holds on to important items of value, like the buyer's funds and the seller's signed deed, until all the specific conditions of the purchase agreement are fully met. Once all conditions are satisfied, like the buyer's loan being approved and funded, the title insurance policy being ready to issue, all inspections completed, and all necessary funds collected, the escrow holder then records the deed with the county, officially transferring title, and disperses the funds to the seller and other parties according to the instructions. In California, various entities can legally act as escrow holders without needing a separate, specific escrow license. These include banks, savings and loan associations, attorneys when acting for their clients as part of their legal representation, and, very commonly, title insurance companies. Now, crucially, brokers can also act as escrow holders for their own real estate transactions, but only under very specific, limited circumstances that are often tested on the exam. They must be the listing broker or the buyer's broker for that particular transaction. They have to be directly involved in the sale itself. Providing escrow services cannot be the majority of their brokerage work. It has to be incidental to their main business of selling real estate. They cannot advertise escrow services as a standalone service to the general public. They cannot form a separate company solely for the purpose of providing escrow services under this exemption. This exemption applies only to the responsible broker themselves, not their supervised agents, although agents can certainly provide administrative support for the escrow process. And, perhaps most importantly, all escrow funds handled by the broker must be kept in a dedicated trust account, meticulously separate from their personal or business operating funds, adhering strictly to all those rules we discussed earlier about commingling and proper trust fund handling.
Okay, lots of limits on brokers acting as escrow. Good to know. Outro. Wow. What an extensive journey through some of the trickiest and most foundational concepts in California real estate. We've really covered a lot of ground today. We've tackled everything from the broad powers of the DRE and the critical nuances of disciplinary actions to the intricacies of agency relationships, those complex loan calculations, and the precise definitions in property law like nonconforming use and the different types of deeds. You've now taken a deep dive into those areas that previously might have caused confusion, hopefully transforming them into points of, well, profound clarity.
That's absolutely the power of focused learning, right? And really understanding the why behind the rules, not just memorizing the what. By understanding the subtle distinctions between concepts like, say, commingling and conversion, or the precise applications of the ADA versus the FHA, and the exact implications of terms like non-conforming use or the VA loan entitlement percentages. Well, you're not just memorizing facts for a test, you're truly comprehending the interconnectedness of all these regulations. And this really raises an important question for you to think about. How does this detailed understanding of seemingly small legal or financial distinctions fundamentally change the way you would approach advising a client, or even making your own significant real estate decisions? This knowledge doesn't just help you pass an exam, it truly empowers you to navigate one of the biggest investments of your life, or, just as importantly, to confidently and ethically help others do the same.
That's excellent food for thought. How does this knowledge truly empower you? Great question. Thanks so much for joining us on this deep dive. Keep learning, keep questioning, and keep building your knowledge base.